Rai. Last but not least, we have Dr. Juzhong Zhuang, who will offer his views from a regional perspective. Dr. Zhuang joins us from the Asian Development Bank, where he is the Deputy Chief Economist, and he works in the Economics and Research Department of ADB. He has been with ADB since 1997, and previous to that, he was with the Development Economics Research Program at the London School of Economics. Dr. Zhuang.
Thank you. First of all, I would like to thank the organizer for inviting me to this forum. In the next 10 minutes, rather than commenting on the studies and presentations by IMF colleagues, which are excellent and very comprehensive, I would take this opportunity to present the key messages of latest Asian Development Outlook, the ADO. ADO is Asian Development Bank's major publication, provide economic analysis of 44 Asian development economies. So I will present the key highlights. Now, these 44 economies we call developing Asia. Yeah. Sorry. How this work? It is too far. This one. No. Okay. Yeah. Sorry. Yeah. Okay. So I'll basically make 3 points. The first is the global economic outlook. The second is developing Asia's outlook. The last is the key challenges the region face. Now, on global outlook, I think our assessment is very much consistent with IMF assessment. By the way, our report was released in the first week of April, and IMF WEO is the second week. So we are 1 week earlier than the WEO. Yeah. So basically, we expect the pace of recovery in major industry economies remain modest this year and also next year. Now, in the United States, where there is a growing case for guarded optimism, we expect the growth, the GDP is going to project to grow at 2.8% this year and 2.6% next year. In Eurozone, where the outlook is mixed, with some economies recovering faster than others, the GDP growth rate is 1.6% this year and also 1.6% next year. In Japan, where the recent earthquake has increased the uncertainty, we expect the growth to be at 1.5% this year and 1.8% next year. Now, 1.5% this year, that projection was made 1 week after the earthquake. So this number may be on the upside. We have to look at in the next round of the assessment. Okay. Then this outlook is subject to a number of risks. I think my colleagues from IMF already mentioned. The first is the surge in oil and food prices, and the second is sovereign debt problems in the Eurozone, peripheral countries, and then we have high unemployment and a weak housing market in the US, and impacts of the Japan earthquake. These are the 4 risks we highlight. I'm not going to go into detail. Now, coming to regional outlook, so in contrast to the modest pace of recovery in major industrialized economies, developing Asia's recovery is firming. The developing Asia as a whole grew at 9% this year, last year, 2010, and then we expect the growth to moderate a little bit to 7.8% 2011, and 7.7% 2012. That modulation reflects a number of factors. Number one is expected lower growth of global trade. And second is a normalization of fiscal and monetary policies in many countries in the region. Third is higher oil prices. And then, of course, we have a larger base effect because last year growth rate is very high. Now, the region's growth has very much largely driven by robust domestic demand. In this chart, basically, we select a number of countries. The yellow area is investment, domestic investment, and the green area is the private consumption, domestic private consumption. So we can see the region's recovery very much driven by domestic demand, including both consumption and investment. And also across the region, recovery is quite broad-based. We can see all the sub-regions: Central Asia, East Asia, South Asia, and Southeast Asia, and Pacific. So all registered strong growth last year, and then expect to remain strong this year and the next year. This is basically the two major economies, two major regional giants. In China, growth rate last year reached 10.3% and expected to grow at 9.6%, 9.2% next year. And India also, 2010, 8.6%. And this year, the growth is a little bit slightly lower, 8.2%, and next year will be 8.8%. Now, Southeast Asia region is also doing quite well. For the region as a whole, last year growth rate was 7.8%, and then we expect for this year growth it will moderate to 5.5% this year, and then 5.7% next year. The Philippines, last year the growth very strong, 7.3%, and this year we expect the growth to be at 5%, and then 5.3% next year. I don't know what our projections, whether we're consistent with the central bank here. Okay, now the last the issue is the key challenges. This report, we highlighted two challenges. One is short term, the other one is long term. The short term challenge basically is inflation. Now, as already mentioned by IMF presentation, because of the robust recovery and also because of the expansionary monetary policy during the global crisis, the inflation is building up. And then last year, inflation was 4.4%. And then this year, we expect for region as a whole, inflation will be 5.3%. Next year will be slightly low, 4.6%. Now, I'm not going to go to this because the IMF presentation already touched on basically some countries have shown signs of overheating. And I just want to highlight the point that inflation is very important. It matters more for Asia because Asia is still the home to 2/3 of the world poor. And so the poor is especially vulnerable to inflation. So that is, I just want to mention that. And but fighting inflation is not easy because, as I already mentioned, if you're tightening monetary policy by raising interest rates, and you can attract the short-term capital flows and increase domestic liquidity, so complicated problems. So basically, what we're saying that fighting inflation will require a coherent policy mix for countries with persistent current account imbalances and misaligned exchange rates. We can use more flexible exchange rates. More flexible exchange rates, basic appreciation could be a good option, of course, together with other tightening measures. But for countries without this symptom, temporary measures such as capital control can be option. ideally, of course, will be carried out in an internationally coordinated manner, as mentioned by my colleague from Central Bank. And in this regard, the G20 is working on practical indicative guidelines for assessing imbalances and principles for capital control. That could be provide useful tools. Now, the long-term challenge we highlight is basically the region needs to find new sources of growth, because for the modest recovery in industrialized economies, developing Asia, we need the new sources of growth. In this regard, we focused on the source links. Source economic links are expanding. And there's a potential that link could take up the slack from the north. Basically, we found the source trade is growing. Trade is growing from about 7% of global merchandise trade in 1990 to 17% in 2009. Of course, source has also emerged as an important source of outward FDI. Now, the problem is much of the source trade, especially the intra-regional trade in Asia, very much dominated by parts and components and assemblies. So that demand cannot be considered as independent from, still very much dependent on the industrialized economies. So that needs to be changed. Basically, we have to increase the source trade in final goods. And then how to do that? We argue that there are structural weaknesses, especially source trade tariff on the source trade is 3 times high as the tariff on the trade among the northern countries. So tariff level should be reduced, and also, of course, non-tariff barriers like infrastructure, logistics, the increased transport costs should also be reduced in order to maximize the potential of the source of economic links as a new source of growth. So here are the summary of the key messages. The Asia recovery is forming with a growth nearly 8% in the next 2 years. Asia is leading the global recovery, and rising inflation is a concern. And expanding source of links present a supplementary growth source, but structural weaknesses needs to be addressed to maximize their potential. Thank you very much.